Joining us now is Julia Pollak, chief economist at ZipRecruiter. The company published its Q2 new hire survey this week. Julia, great to have you with us.
Thanks, Melissa.
One of the things that surprised me from the survey is how easy it is to get a job still. I mean, the amount of time that you have to spend, looking for a job is not very much, and job seekers feel enough power in this market to actually ghost employers.
Employer ghosting is going up, not down, and that suggests that job seekers are still very confident. The share that are satisfied with their new jobs keeps rising. The share getting signing bonuses, getting proactively recruited by employers, all of those keep going up. We have seen a decline in the share getting job wage increases when they are job switching. So we do see a little bit of a pullback, but not that much.
Where are you seeing the most strength in terms of industries?
So this is still a market very much being propped up by strength in consumer spending and in those consumer services industries. Americans, especially high-wage Americans, are flooding to those Taylor Swift and Lizzo concerts, to the baseball games, and on vacations still. And so those industries are continuing to buoy us. But industries where we would expect to see much more weakness, like construction and manufacturing, given how high interest rates are, have proven remarkably resilient. And part of that's because of the enormous amount of private investment that's being stimulated by subsidies.
Are you surprised that the job market has held up this well in spite of 10 consecutive rate hikes?
Well, I think everyone is surprised. No one would have expected that raising rates 5% would cause unemployment to fall or hold steady. Everyone expected that that would hurt the labor market more. It seems now that may not need to happen, that inflation is coming down quite meaningfully. Many of the real-time private sector indicators suggest that it's actually coming down faster than official statistics show, and that we're closer perhaps to that 2% target than Fed members yesterday suggested.
So if wage growth has been sort of the fly in the ointment here. And so can we have a situation where wage growth may be slowing, which it has been, but it still remains strong, even though inflation has come down? And that's okay, because that would imply, I mean, if I'm going to extrapolate onto corporations, that corporations will be feeling the pain in terms of margin compression.
Yes. So right now, workers have seen 25 consecutive months of real wage declines. The only workers who've received a real wage boost are the lowest wage workers, but they've also been hardest hit by inflation and have very little disposable income left after essentials have gone up so much in price. And even though inflation is coming down, consumers are looking at what's happened, and they're looking at cumulative inflation. They're saying prices should have gone up just 6% since the start of the pandemic. Instead, they've gone up 17%, and my wages haven't kept up. So there will still be a tension between employers and job seekers and workers in those conversations about offers, about raises, about promotions, with workers saying, hey, I've been left behind here, and you need to catch up. So that'll continue to be a tension in the market, and it will keep inflation higher than the Fed would like. But we're seeing so much relief on other fronts that I think the picture is still quite bullish.